Hey everyone, I am Sean Farrell, head of digital asset strategy at Fundstrat. Hope everyone is happy and enjoying the resurgent bull markets that we are currently in. Today we're joined by Dave Siemer, co-founder and CEO Wave Digital Assets. Wave is SEC registered investment advisor. Their goal is to bridge traditional asset management to digital assets in a very similar fashion as we try to bridge crypto and Wall Street research. Um, they provide investment fund solutions, but also provide liquidity provision, treasury solutions, and other ancillary services. So they actually have a pretty diversified number of revenue streams. But I am not going to belabor that point. I'll let Dave tell you about it himself. So let's bring Dave in here. Dave, how are you doing today?
I'm great. Thanks for having me, Sean.
Yeah, happy to have you. So before we get started, I know you have a little presentation you're going to share with um, our
Mhm.
network. But before we get started, how about you tell me a bit about yourself? I'm sure people are curious about your background, how you were drawn to crypto, and kind of how the founding of Wave Digital Assets came about.
Sure. Yeah. I mean, so I took a little unusual route, but I've always been kind of fascinated by technology. I started after being a programmer for a little bit. I started as a VC in '95, so I kind of had a front row seat to the rise of the internet. Eventually, after B school, left VC and went to investment banking. Worked for Montgomery, sold a lot of the biggest, pretty much all the large social sharing sites: YouTube, MySpace, Club Penguin, about 100 of them. And so I did that for several years, eventually left and launched my own investment bank slash venture fund back in 2007, which sounds more glorious than it was. I was a one-man show working out of my apartment, but somehow the business idea worked. The venture funds grew up, raised about $1 billion now. Largest LPs are like Thomas Eck and several other sovereign funds. The other side of the business was a cross-border tech M&A bank that became pretty sizable. And I mostly mentioned that part of my crypto story is it really kind of led me in. So before I sold that to China Capital, big Chinese bank, I had broker-dealer equivalents on 4 continents, 7 countries. And I had to take securities exams in all of those, which was a very interesting background for someone that eventually fell into crypto. And then crypto story is pretty simple. I had dumb luck. So one buddy of mine that was based in LA at the time, a guy named Adam, gave me 50 Bitcoins in February 2010. This is when 50 Bitcoins combined were maybe like $10. They were 20, 25 cents. You couldn't buy them then, but that was like the mining cost. And so he gave it to me. I had no interest in it at the moment, but I kept them, and I was just kind of like, as it kind of thought about it. And when I was a VC starting in '95, I focused mostly on open source software and, digital assets, especially, Ethereum, world machines, everything is really just open source software on steroids. So I got pretty excited about it. Did pretty much invested in pretty much everything in like the 2011, 2012, 2013 crypto world, which was one of the angel rounds of like Kraken, Bitfinex, BitGo, Tether, like all a lot of stuff. I was running a very regulated, FINRA member bank and whatnot, so I did it very quietly compared to a lot of my peers, but was quite active. And then, fast forward a whole bunch, launched my first crypto VC fund in 2017, and then that kind of led us into forming Wave Financial. So the real origin story of our company was, typical entrepreneur story of solving my own problem. By end of 17, I had a couple hundred different tokens to my name. And managing that became the bane of my existence. Yeah, I think a lot of people, you've been in crypto for a while. A lot of people on this call have been maybe a little while. And that was when, you'd buy a SAFT, you'd get tokens, a year later or something. They get listed on some bizarre South Asian exchange. So you'd be, faking my way through Google Translate, trying to open an account so I could start selling. And as soon as you start selling, the price would tank because all the volume was fake back then. And anyway, so I started building a team of some young traders. I'm not a trader, to kind of handle that. And once I got a bit of a handle on it myself, just started talking to a lot of my friends that were also kind of the early, kind of 2010 vintage guys in crypto. And they all had the exact same problem. Like all of them basically said, oh my God, like take mine, do me. And being a regulated guy, we went SEC registered day one, set up Wave as a, SEC registered firm before our first dollar of AUM. onboarded a lot of the kind of crypto OGs, we used to call it, as kind of our initial clients, and started liquidating. And once we started kind of managing assets for them, derivative strategies, yield strategies, a lot of just liquidation strategies, to just turn their what we called shitcoins back then back into Bitcoins, or Ethereum, or whatever they were most passionate about. And that was kind of the origin story of where we've come from.
That's great. I'm curious, and I might have missed this. Those 50 Bitcoins, when did you sell them? If you did.
I haven't yet. They're sitting
You
in my
haven't?
kid's truck. No, I bought more. I mean, I got 50, and then which wasn't a lot of money. And then Bitcoin went to like, I forget what it was. Like first bought them again, it was like $8. And I remember sitting around with a bunch of my old friends that were they were bigger advocates. Me like, man, these things could be like $100 someday. So I bought a couple thousand more, and I bought more, and I kind of over time. And then I sold, as everyone does in crypto, it's a rite of passage. I sold a bunch too early. So I think it went up to like $50. And I was like, okay, that was kind of my thesis. So I sold like 70% of them at $150. I kept a few thousand, but I sold a ton of them. And then it went to 1,200 pretty quickly, like a month later. So I thought I was an idiot. Then I went back down to 180. So then I bought a bunch of them back again. And then just kind of wrote it on up for some of them.
Those are a pair of diamond hands you got there. I must say.
I would have held all of them. Would have been better. Yeah.
So that's a pretty intriguing story. Obviously you're in it way before I was in it, and I think most, 99% of the industry was in it. I mean, those rounds back in 2011, you could count on one hand how many people were talking about Bitcoin and the wider crypto ecosystem at that point. So hats off to you for your long tenure, because we all know that 1 year in crypto is 7 to 10 years in real life.
Yeah,
So how about, I know you brought a deck to share with our network here, and have some you want to go into a little detail about Wave Digital Assets. So I'll just hand the mic over to you to kind of bring our viewers through that, and feel free to touch upon any as specific as you want about Wave.
Sure, yeah, and I'll try to make it a little brief. I like conversation. I'm sure everyone likes conversations more than forced march through decks. Let me share my screen, and we'll go through that.
Oh, and Dave, before you begin, let me just remind everyone tuning in that after Dave and I chat, we will be addressing questions from the crowd, live Q&A. So make sure you leave those questions in the chat so we can get to them later.
Perfect. Yeah, that'd be more fun. So I'll go through this a little bit briefly and kind of quickly, and then let people ask questions about it. So as you mentioned, we've been SEC registered day one. We're actually over 40 employees now. This might be a little bit dated. And we were really built, again, as a bridge between traditional and digital assets. The whole thesis we launched the company going way back into like 17 was that there would be this huge rush eventually of institutional players and people high net worth that wanted to get in the space. We were wrong. There was not a rush. Then there is now. We were a little bit early in that thesis, but everything kind of worked out anyway. And what we offer clients, we basically have 3 legs of our business, which I'll kind of go through pretty quickly. So one leg is the first thing we started with, wealth and treasury management. So our biggest clients in that business is by far crypto. We call crypto corporates. So think it's protocols. Manage assets for like Cardano, Ripple, a whole bunch of other like very, very large tokens. We manage a lot of the digital assets for them and some cash assets occasionally. We work with a lot of crypto high net worths. So that's just what you would think of, rich people in crypto that don't want to spend all their time doing these exotic strategies or even staking or whatever. We do that for them. And then we have a funds business that is, we have 11 crypto funds now. They do various strategies, 3 VC strategies, a bunch of, I go to a slide on this. There we go. A bunch of VC strategies, yield strategies. We did one of the first tokenized hard asset funds around whiskey barrel aging, which everyone asks questions about, but I'll get to that later. And then our newest business we launched about a year ago is working with governments and bankruptcies. So we did a lot of liquidations for some of the very known bankruptcies that are out there. This is an interesting moment in crypto. But we also kind of looked around the world when crypto went into the bear market, towards the middle of 22 and said, this sucks. One, a little bit less fun than the bull market. But two, they're kind of realized how many dollars had flowed to government hands. So about $70 billion of crypto sits in various government agencies and some of the bankruptcies, which is more than every asset manager in crypto times three. So we said, great, we're registered and we're not in trouble with the SEC, unlike a lot of our peers. We should go work with them. So we do. We are the retained educators of the US IRS, FDIC. We do do a bunch of work with the US Marshal and a bunch of others. So we're and they have tons of assets and they're a little bit less sophisticated, quite honestly. So that's, and I tend to jump around on my decks a lot, so I'll apologize for that in advance. So that's kind of our main business units. We put together a pretty interesting TradFi team. TradFi is our term for traditional finance, as opposed to digital finance. So I won't go through a lot of this here, but we have a very senior team that's been around through a lot of things. I won't read this slide either, but I'm sure we're happy to send this out afterwards. One thing we're pretty proud of is we've done a lot of firsts in crypto. We launched the very first crypto derivatives-based fund in existence. We launched the first NFT fund. We were the first and largest wealth management platform since our beginning. There really is almost nothing else like Wave, and kind of on and on. So that's kind of what's kept us at the forefront of everything. And we really leveraged our venture funds for that also. Like we launched the first, pure DeFi liquidity provisioning fund in existence a couple of years ago. I can explain what that means if people want to ask questions about it. But it was anyway. So just but being an early stage VC in the space, we operate 3 VC funds. We invested in all the interesting DeFi protocols at the earliest stages. And that really helped us build a lot of expertise in how to manage what we think is the next wave, if you will, not to be a punish, of what finance is going to look like when it decentralizes. One thing we always have to point out, it's a little bit sad, is that we are one of the few kind of survivors in crypto. And as a business person, this has been the most fascinating part of this journey so far. Is 7 of our largest 8 competitors all managed to kill themselves. As an entrepreneur, I'd love to say we were just so good we put them out of business, but that's not the case. But on the high net worth side of our business, we did compete with like the Celsius and BlockFi's of the world, and frankly they were very hard to compete with because they were just giving away all the money, all their VC capital, which we didn't have to give away. And offering these ridiculous yields. Obviously, they were able to offer these ridiculous yields because it was ridiculous. It was unsustainable, and they all blew up. And then on the more corporate side of our business, like where we work with like protocols and miners and so forth, we did compete with Alameda and Three Arrows and Genesis and whatnot. And yeah, so all of them. So again, a lot of our competitors exiting the market has been very, very good for us, to say the least. And I've never seen anything like that in business ever. I've been in VC for a long time. I'll just jump past this. These kind of different groups we service, and kind of how we see the world as far as our approach to market. And this is talking about our government business here. So again, this has become a huge initiative for us. For the governments, we basically do all the things you would think of for high net worths, but it's actually really interesting to do for a lot of these government agencies because the assets tend to sit there forever. So like, the first major seizures in all of crypto were Mt. Gox and Silk Road, which happened in 2013. All those tokens are still sitting there. We're now managing a portion of them, and they're going to be sitting there for many more years. So it's as a asset manager, it's really lovely when you have a group of entities that are not very sophisticated and will just park the assets there for a decade. So we've been kind of focused on that, and we do a lot of different services around that. And why we're on the call here is, we've raised about half of a capital raise that we're targeting. So Wave itself is on a parent level is raising 30 million. We've got 17.5 committed, including some from pretty marquee investors, one of the largest, traditional hedge fund manager investors, and a couple of the largest crypto platforms are investing in us. So businesses, and the point of the cap raise is really just expansion. So right now, Wave is one of the largest USA investment advisors, certainly the biggest in crypto. We acquired a company called Kryptonite in the Swiss market that's FINMA regulated. We're in the process of opening Abu Dhabi and Singapore offices. And again, when all of your competitors kind of nicely exit the market for you, it's a great time to expand, and we have a great platform reputation. I think I forgot to mention this on the previous slide, but Wave has had no damage to any of these crazy cycles. We really understand. We have a risk monitoring team. We understand counterparty risk and proper fiduciaries and whatnot. So we've had no damage whatsoever. We've never lost ours or client assets in any meaningful, either DeFi hack or scam or bankruptcy or whatnot, which makes us pretty unique. And yeah, and we just see this as a great time for consolidation. So a lot of the capital raising right now is for expansion, and the other part is for some inorganic growth. So I was M&A banker for 13 years. There's a lot of companies that are pretty damaged in crypto right now that we've been looking at acquiring. I mentioned the European we acquired. We acquired a staking business a little while ago as well to provide staking to all our clients. And there's a bunch of other types of assets that fit into our business that we're kind of evaluating right now. Actually, a list of like 100. So that's the other kind of use of funds for what we're trying to do. And I'll keep this real short. I mean, that's pretty much it. I mean, this is one of the bankruptcies we did. I won't go into this. We liquidate assets for large bankruptcies, and we also store the assets. We've done several of these deals so far. These are 2 case studies right here. And I think that's pretty much it. So I'll take this out of sharing, try to keep that mercifully short.
No, I think you said everything you needed to say in the right amount of time. It's not short. I thought that was great, and a great overview of kind of what you guys have built, how you guys have brought Wave through what was a very tough 2022. Something that stuck out to me was, last time we had you guys on, I think it kind of focused on new fund solutions, which clearly are a big part of your business. But to me, it seems like you guys have done a really good job of finding other opportunities and other ways to do business, despite the market conditions. Is that, how do you guys view moving into new offerings? How do you assess different opportunities that might be out there? Because I'm looking at your bankruptcy solutions, government solutions, liquidity provision solutions. There are several ways you guys have found ways to make money.
Yeah, I mean, it's been a little bit more. Wave itself only raised about $5.5 million to date, prior to this current round we're just closing. So we never had the luxury, some of our peers did, of Celsius raising 800 million or whatnot to kind of experiment. So most of our fund creation has been just organically finding out what clients wanted and then putting a vehicle around that when we had a couple of anchors. So we're launching 4 additional crypto funds right now. We have 11. We'll soon have 15, which sounds like a lot, and it is, quite honestly. But all of them are already have many tens of millions of dollars in anchors. So some of the anchors are our clients. Like we're launching 2 of those are funds that we're launching with protocol partners. So I won't go post NDA. We're happy to share a lot more details, obviously, but the 2 protocols we're launching specific vehicles with, which are DeFi vehicles, or top 20 coins on CoinMarketCap. So they're big protocols. They allocate pretty big dollars to us. This is solving a problem in their ecosystem. So the biggest thing we've done recently is a lot of things around decentralized finance. So there's a lot of these big protocols out there, and DeFi went to crap. It's kind of coming back right now. So at one point there was $500 billion locked in DeFi. It went down to 35 million. It's back to like 60 million. But it's down 85%. Which that means is that if you're, I'll pick someone we're not working with. So if you're like whatever, it's a good example that we work with a lot of companies. Anyway, so if you're like Telegram coin or Ton coin or something like that, and you're and you have a bunch of your DeFi is just launching, and you have a lot of new protocols and applications that are being built on you. All of those need lots of capital to function. This is decentralized finance. There is nothing centralized. So if only like a couple $1 million shows up into those DeFi applications that are built in that layer 1, it's basically non-functional. Meaning that if you go there, whatever it is, if it's an exchange, you get a centralized exchange, or if it's some kind of synthetic asset platform, like a stablecoin, algorithmic stablecoin platform, and there's not much money there's no one to trade against, you imbalance your slippage is incredibly high, things like that. So it's just non-functional. So we work a lot of the big protocols. We actually take money directly from them. It's going back into their ecosystem. And we invest that money into all these different DeFi applications. And that kind of shows the rest of the world that these applications are pretty substantial. So if there's $20 million sitting in a new, say, like decentralized exchange, to keep it simple, which we can do with our partners, then it works. Then you can trade against it, at least at decent volumes. You can't do, $10 million trades, but you can do $500,000 trades. And so forth. So that's how we launch a lot of our products. And then on the government side, we're launching a couple of funds right now to basically either buy out or kind of, manage government assets for liquidations and so forth, which is a very profitable business. So the government takes a long time to explain, but it's pretty broken in the way they're doing things. Now that Coinbase and Kraken, Genesis, everybody is being sued by the SEC, no governments can work with those companies. Which is interesting. We're in a good position where we're not being sued, and so forth. So we are able to work with a lot of these organizations, and again, they maintain, they have huge amounts of assets.
Yeah, I definitely want to get more insight from you on your perspective from a regulatory standpoint. But just to put a bow on DeFi. As a liquidity provider and seeing how spreads move and how order books change, have you seen things become more liquid? Are there any particular areas of DeFi that you've seen become more interesting or more traversed as of late?
Yeah, I mean, our excitement around DeFi is probably a little different than the typical crypto, fan, I guess. So, DeFi started as a bunch of crypto bros, trading money with each other to earn incentives. So it started pretty broken. It was highly incentivized. Everyone was there for incentives. Some people were there for actually swapping assets or doing things, but everything was so incentivized that most of the $500 million that ended up there at the peak in late 21 was there just because if you put money in a DeFi platform, you got this other token that they just invented, and you could sell that token for a lot of money. And then obviously when the market crashed, most people don't realize how bad the crash was. I mean, it wasn't terrible, but it was, Bitcoin went down, 65%, but even the large assets, Solana went down 93%, Cardano was down 93%. And those are the big assets. Now, these small assets were down 98%, like the number 100 token, which is, say it was a dApp that was built on Ethereum or something. Those things went down like 98%. So all of a sudden there were no incentives because they didn't have any more, they couldn't give away that many tokens. They'd run out of tokens. But a lot of that washed out a lot of things out, which was really, really great. Now, the next wave of decentralized finance is all about how do we bring real world assets? So think about like a money market fund, like a US dollar based money market fund or S&P 500 shares. And what DeFi built was insane. Like there's whatever, I think 2,000 or 3,000 decentralized finance applications that were funded and launched in DeFi. So in crypto, we refer to those as primitives. So we built all the primitive technology or say baseline technology you need to rebuild most of the world's financial system. Some of that has fiat rails attached to it. A lot of it doesn't. But every type of exchange, spot exchange, derivative, futures, synthetic asset exchanges, you can deposit Ethereum, mint a synthetic Bitcoin, take different leverage positions. All of that has been built over the last, say, 4 years, which means it's now ready for real assets. What most people don't realize is to look at where DeFi is going, you have to forget about the US for a second, or forget about the first world markets. Think of emerging markets. So I was one of the early investors in Tether, the first investor. One third of all Tether actually doesn't sit in like DeFi places where people kind of think it does. It actually sits in Africa. And it just sits in people's bank account. Their local currencies are bad, all very high inflationary. But those people are just desperate for dollars. So they buy Tether, and Tether obviously has lots of bad rumors around it, and deservedly so, and a lot of other things. So it's not a great medium, but it's a lot better than holding Kenya shillings. And Kenya is actually one of the best countries in Africa. But that currency is down 70% this year. So that's where a lot of that sits. So now think about what a money market fund is. Not that exciting if you're in the US. You get 5%. It's nice. But if you're in sub-Saharan Africa, you're getting US dollars is absolutely incredible. That is your dream. Literally, US dollar bills are illegal in most of Africa. They're illegal in Argentina, all these high inflation countries. The last thing the government wants you to do is hold someone else's currency, because that's how they survive, by printing money. So there's huge demand. So if you look at BlackRock, with everyone knows about the Bitcoin ETF they're trying to launch. they've also hired 100 developers to tokenize the rest of their funds. There's 1 billion people roughly on the planet that have access to the global stock markets, say their S&P 500, ETF. There's 7 billion people that don't. And obviously the richest 1 billion people do have access, but the 7 billion people combined, it's a bit of money. And all of that can live in a decentralized world eventually. Now, there's a lot of things that have to be built, and KYC and all the different tools that are being built right now. But eventually, we're going to see all of that come to DeFi, so that someone in South America or Africa or India can buy a U.S. money market fund, like Franklin Templeton tokenized theirs, or one of the bigger ones, or they can buy the S&P 500 and whatnot. So I think that's really where we see most of our excitement around crypto in general is that when the real money shows up, which will be, tens of trillions of dollars that can be now available on these types of platforms, then you don't need incentives. There's actually real dollars there, real volumes.
Right.
And that'll the beginning of when we really see finance start to change.
Yeah. I think the term that people in crypto like to use for this is real world assets, right? Bringing, I think a better term might be traditional world assets, right? Obviously the number one RWA for short, our stable coins, dollars on chain. And to your point, I do think people really just discount a lot of the market potential for crypto because they just assume that the developed world looks like the rest of the world and don't understand how difficult and in high demand access to liquid capital markets and US dollars are in developing nations like the ones in Africa or in South America, what have you.
Yeah, what actually, one funny anecdote, what got me really excited about crypto in 2013, a friend of mine had a Bitcoin ATM company, and they put one of their ATMs in Zimbabwe. This is before it was illegal. And he put a camera over it. And he gave me the IP link so I could just look at this. And at any point in time, in the middle of the night, there were 300 people online trying to exchange their whatever Zimbabwe dollars were at that time, like $1 billion to 1, for Bitcoin. And they were charging 12%. It cost 12% to exchange Zimbabwe dollars to Bitcoins. And there were never less than hundreds of people in that line, just dying to get a currency that was better than the garbage they were holding in their wallets.
That's fascinating.
Yeah. And they're still there. Sure. Now the Bitcoin ATMs are illegal in Zimbabwe, but there's an underground network now where for 20% above the price of Bitcoin, you can buy Bitcoins in Zimbabwe from humans.
Yeah, it is already here. It is a speculative hedge against monetary debasement, but in many countries, it already works quite well. So let's circle back to the regulatory question. I see we actually have, and I'm going to start layering in some live questions here. And there is a question about, your regulatory outlook and kind of how you're viewing things. I think you sit in a particularly interesting seat because Wave Digital Assets is global, as you mentioned, and is looking to expand even further. So I'd be interested to hear from you how you are viewing things from a regulatory perspective in the US and, how that is juxtaposed to how things are going elsewhere in the world.
Yeah, and it's obviously a very different story depending where you sit in the world. So the U.S. is the worst right now. I mean, just from a administration standpoint, they're putting bullets in a lot of companies right now, or trying to. Europe is better. UK is actually pretty lousy still. Surprisingly, I figured Brexit would get them a lot more excited to really embrace some of these things. Not yet. MiCA 2 in an EU region actually is really, really positive. It's a little ways away. A lot of things they got right. They obviously got a lot of things wrong also, in my opinion, in the legislation that's coming out, but at least they have a framework coming out. But then the more optimistic parts of me look at the rest of the world. I mean, Japan is all in on crypto. The 4 largest banks own like half of all the exchange licenses, crypto licenses. They all own, have fully built and live custody solutions. They allow retail to buy crypto. All 4 of the largest banks in Japan have license now to issue their own yen-based stablecoin. So kind of their competitor to the Chinese version. Then you look at like Hong Kong and Seoul and Singapore that, there's some ways compete with Tokyo. All of them become incredibly positive recently. I think Hong Kong gave out like 40 crypto custody licenses in the last 6 months. So I guess anyone can have one. If anyone they call wants a custody license, it's like 30 grand. You can get a custody license in Hong Kong, which is kind of amazing, or Macau. So, you're seeing all those regions explode. I was just in Dubai a few weeks ago. I mean, the Middle East is just in a battle to see who can write the most crypto-friendly laws. So it started with Dubai, then Abu Dhabi took the lead, then Saudi Arabia, then Qatar, then Bahrain. But they're literally just talking to everybody and saying, okay, you're a token issuer. What would be your dream scenario? And then they write that into law. Pretty much. We had some of those conversations. So that's kind of amazing. I mean, South America is opening up. So if you take the US out of the equation and a little bit, maybe UK and whatever, like the rest of the world has gone completely positive, and everyone competes. I mean, the US is slow to compete sometimes, but they always end up competing fairly well eventually. All the past history examples, they eventually got to the right place that are pro-business, pro-hedge fund, so I think everything will get there. What we've seen in the space has been, in the US in particular, this is a little bit true of Europe, has been just really fascinating on a couple levels. Like they've, the US, SEC has, basically gone after all of the exchanges. And they were going after all of the lending platforms, but those all blew up anyway, so they didn't have to keep going after them. They mostly managed to disappear. And what we're seeing is just really kind of a targeted plan, to basically hit all the crypto companies. It makes it hard for TradFi companies to work with them. So I think at one point, 10 of the 12 Bitcoin ETFs were going to be housed at Coinbase custody, and then they got sued by the SEC. So basically, all of those are now, what we hear, being told by the SEC, yes, approval probably is coming, but not if you're using someone we don't like. So switch to someone we do like, and there are other custodians that they are not suing at the moment. So all of those are being switched. And then what we also saw the SEC do, and a lot of this isn't very widely known, but it's all public, is they gave 3 approvals out to new exchanges / custodians. So EDX, Promethean, I forget the third one sometimes, that are now fully SEC blessed, regulated exchanges. Various ones are invested by BlackRock, Fidelity, Citadel, Apollo, kind of on down. Every major kind of finance incumbent that is edging into crypto. And those are all perfectly fine now. So
those are the exchanges that have the clear to, just to clarify here, to trade crypto asset securities, right? So yes. You could take Apple stock, pack it into an on-chain asset, and trade it on there.
Right. So they have a little different exchange licenses, full stock and crypto custody licenses, and stablecoin holding licenses, and everything else. So they're basically blessed to do everything. They're all starting as institutional only for kind of obvious reasons, but they'll all go retail eventually. And obviously, once those exist, the EDX, I think, is the first one that'll probably launch in about 2 or 3 months. They'll get all the institutional traffic, because the institutions can't work with anybody that is being targeted by the SEC probably. So they will, they'll become they'll take over all that institutional volume, which eventually will be the majority of volume anyway. So they'll, so great for crypto in general, lousy if you're a Coinbase shareholder, or whatnot. But we'll see. And now we're seeing everything get blessed. Once those are in place and they're basically owned by the Goldman, BlackRock, Fidelities of the world, which they are, in most cases, are mostly owned. Then that's when I think we'll really see everything really kind of open up. And there'll be fully regulated channels. If they do anything wrong, the government's very good at fining the JP Morgans of the world. And they paid them $30 billion in fines in the last 10 years or something. So they have somebody they can kind of hit every time something goes wrong, and they acquiesce really easily to those fines. And then everything will move forward in the US. I think we're probably, the ETFs, I still think are probably on track for late January, if not sooner. So very soon. And then a whole bunch of other things will probably fall in line after that. And again, what they're doing is, the custody rule, basically, that'll probably go into effect. So the SEC proposed something called a new custody rule in crypto, which will, at the earliest, will probably go into effect in January of 25. But it basically only can be adhered to if you're someone to scale of like State Street or Apex or BNY Mellon, whatever. For the rest of the small crypto custodians, they could never meet the requirements around settlement clearing. It doesn't exist now anyway. So you'll see all these things kind of get pushed to the large players, and then the SEC will be fine with it.
That is on the custodian front. That is the mandate that requires RAs to hold assets with qualified custodians, or am I thinking about something different?
That is it, but it also more narrowly defines what a qualified custodian is and how these things have to be handled, which there's only a couple companies in the world that have that infrastructure to do it today.
Right.
The ones I named. So I don't know if any of the existing crypto custodians can get there in a year. It's actually a lot of lifting.
Right.
Or it's almost impossible. It's almost impossible to adhere to because they're the clients of like whatever the Coinbase custodies and Bitgos of the world don't treat them like securities and don't want them to be securities. So there's going to be it's going to be very interesting to see how this all evolves over the next year or so. And no one knows if that rule will go into effect.
Yeah.
It's I would doubt it will go fully into effect the way it's proposed, but the way it's proposed is pretty deadly to the existing incumbents.
Yeah, but on the bright side, I do share your sentiments regarding advancements elsewhere in the world from a regulatory perspective. I think other regimes see the writing on the wall and the inevitability of the space. I'm optimistic that we can catch up in short order. So, but we'll see. So we have let's go turn to some questions from the crowd. Again, reminder, we have some live Q&A capabilities. So if you have any questions for Dave, pop them in the chat. We have a question here from John. Is the plan to move any of your funds to being publicly traded? Which I think is a good question in light of what we're seeing in the ETF issuer market.
Yeah, absolutely. So we've been working this for a long time. We launched the company. I actually didn't. We kind of launched this company accidentally in some levels, but we did look around and got more serious about launching this. We looked around the world, and basically there were about 45 companies we identified. I was a banker for a long time, so I make these matrices that were basically trying to be the vanguard of crypto. Grayscale, CoinShares, 21 Amen, what we call it now, and 40, Bitwise, all these guys. And our thesis always was that, one, those are great. Nothing against those whatsoever. I would love it if there was a vanguard of crypto, and but my thesis always was that it wasn't going to be Bitwise or Grayscale. It was going to be Vanguard, or Fidelity or BlackRock or whatever. Like there's no future where a Bitcoin long fund, the largest one long-term is going to be held by some random crypto, startup. That's BlackRock's business because it's a distribution business. And it's a brand business and it's a low fee business. I mean, all the new Bitcoin ETFs are coming out at 50 basis points. Every Bitcoin long public, ETP or whatever, almost all of them charge like at least 1%, if not like 2.5%. So why would anybody choose, the Bitwise 2% one over the BlackRock 50 basis point one? It's just Bitcoins. There's no balancing. It's nothing to do but look at Bitcoins, and redeem them when people want out or whatever. And Vanguard's is already in process and rumored to come out at 25 basis points, which makes a lot of sense because they can run a whole money market fund, which is a lot harder than a single asset fund for 16 basis points is their largest one. So yeah, we're going to see 10 basis point Bitcoin funds, and that's not very good if you're an asset manager. We do really specialized strategies for our clients, including almost 100% of our AUM has a performance fee attached to it because we do yield strategies, derivative strategies, things like that. So we average closer to like 400 basis points. And I don't want to be in the 15 or 20 basis point business. That doesn't sound like a great business long term, unless you have trillions, which we're not going to because we're not BlackRock.
Right. Yeah, you're just kind of competing on volume at that point.
Yes, yes. Sorry, I forgot to answer your question. So what we're in the process of trying to list right now are multi-token yield funds. So we do yield strategies on tokens like one we announced already is like Cardano. So we do a DeFi fund on that. That's about a 25% APY fund. We are, we can't list it on a US exchange, obviously. That we're very long ways from listing a multi-asset, fund in the US. But in like the SIX exchange and Deutsche Börse and the Nordic exchanges, they're very open to those kind of things. And it's a really cool strategy. Like if you like, in this case, Cardano or ADA, you probably like, staking yields are 3%, you probably like a 20% yield strategy. So again, it's anchored by the protocols themselves. In each case, we're doing one with, Polygon with a whole bunch of others. So very big tokens. And as soon as we can and we're in the process of working through all the legals to get those listed into ETPs in Europe first. And then also we're seeing Singapore and Hong Kong start to really open up. So we probably can do it there shortly thereafter. And a few others. So yes, but again, none of the funds we're going to launch are going to be like a BlackRock Bitcoin ETF. They're all advanced yield strategies.
Yeah, no, that makes a lot of sense. So the yield strategies, are those are actively managed, like delta neutral yield strategies? I think it's probably worth unpacking that, just given our prior conversation about what happened in 2022. And if you don't know where yield is coming from, it's likely that you are the yield. So maybe just unpacking that a bit and how that works would be interesting.
Yeah, so we have a series of these now, like, well, several of them, that are, they're DeFi focused, decentralized finance, and we generally refer to them as liquidity provisioning funds. So I'll keep this really simple for this call, but how a decentralized exchange works is, it's just software. There's no order book. There's no like centralized repository of any of these assets. So basically, if you want to use the exchange, you interact with a smart contract. You can exchange, one Ethereum, for a different token, say like Uniswap or something. If you want to be the exchange, you deposit your assets into what's called liquidity pools. So how these exchange works, again, no order book, no centralized anything. So the first DEX and the largest one still is the Ethereum to Uniswap pair. So Uniswap is the native asset of the Uniswap protocol, which is a DEX, decentralized exchange. So if you want to go trade against that pool, you put in Ethereum, you can take out Uniswap, or you can put in Uniswap and take out Ethereum. And every time you do that, you slightly imbalance the pool a teeny bit. Now it's a very large pool, so it doesn't imbalance much, 100% or something. But if it's a really small pool, you imbalance it a lot. So when we run these funds, and we do run one on Ethereum, but it's not. It's more that's more of a stable coin yield farming fund. So think dollar neutral. So in like the Cardano one we run, it is ADA neutral. ADA is the token of the Cardano blockchain, number 8 token. And all of our fees are actually calculated in ADA terms. So our goal in that fund is, we started off with $100 million of ADA or so, a little more. And then we, from the protocol itself, and then we invest that, we generate yield on that. And the goal is that we have at the end of each month more ADA. Just because no one would invest in this fund as it holds its dry powder in ADA unless they want more ADA. Same thing with like a Polygon fund or several other ones we do. And so that's the goal. So we obviously we do charge a performance fee on the yield we generate, but the yields are pretty good. And we are doing exactly what you would think. We're going into a lot of these smaller applications that are building in that particular case around the Cardano ecosystem, which is one of the smaller ones, but it's still a good one for yields. And it generates pretty strong cash flow.
Great. No, that's helpful. Right. No, thanks for that breakdown. So let's move on to some other questions from our audience. I have a question here from Robbie. Will there be plans to raise a fund related to computational hardware, not just for Bitcoin, but possibly for ZKs? I don't know if that's something that...
No, there's no plans right now. I mean, there are a bunch of hash rate funds out there. I actually think people would be better off just buying like mining stocks. I play this myself. Whenever Bitcoin goes up 5%, the mining stocks seem to go up 10%. And they are Bitcoin mining stocks are all ultra high levered, Bitcoin price stocks. So if you're looking to play, the hash rate around Bitcoin, I think that's more efficient and actually easy money, quite frankly. There is a fund that we just launched that does that. It's a mining stock fund. That basically kind of goes in and out of the market depending on Bitcoin spot prices and arbitrages between the different mining funds, and the team that runs that fund, is one of the old school mining experts that's been in the space since almost as long as me, 2011, and built a lot of mining facilities. So it's not that hard a game. So Bitcoin mining is actually really simple. It's hard to actually execute. It's really simple, basic level. What kind of miners do you have? What's your electricity cost? That tells you what the stock of those companies should be worth in whatever scenarios Bitcoin goes to. So it's really kind of easy to back end into how the market is mispricing.
Yeah, I think there are definitely desks out there that will, that write, futures contracts for hash rate, but I'm not privy to many individuals that use them for speculation. It's mostly for miners, right? Because to your point, I think if you want long exposure to, hash rate going higher, it's just buying the miners is sufficient.
My warning to everybody is I got really close to leading investment in the first North American Bitcoin mine with Jihan Wu in 2014. Jihan's a decent friend, and I actually pulled out the last minute, and a bunch of my buddies went into it, and they lost their ass. And then, so in 2014, well, basically in 2014, every Bitcoin mining company almost died, or most of them died. 2018, same thing again. 2022, same thing again. The three biggest all died. So it's a very cyclical business. So if anyone wants to play that, now is a good time to invest, probably, or a little bit ago. And it's like fun, like owning, what is it called, automotive stocks. And the PE ratio is low is when you sell, and when it's high is when you buy, because the cycles are so violent.
Right. Yeah, no, I hear you on that. And it's a, like you said, it's a very simple business model. It's simple to any miner, right? The major inputs are hardware costs and electricity, and the output is Bitcoin. The issue is, though, that different companies are better than others at managing capital expenditures over a cycle. And as you mentioned, everyone often gets high on their own supply, they do not sell their
Yeah,
biz
they
for
take the, yeah. So
Bitcoin
you
or
always,
buy too
yeah.
much hash rate at the top,
Yeah, when you're
and
in
the
the bottom
cycle
of the market, you want to buy the over-levered idiots that are going to go bankrupt in 4 years, but then you don't want to be in those guys when the end comes.
Right. Exactly.
Leverage
Exactly.
is great in the beginning of a bull run.
And hey, that's what my team is here for, hopefully to help our clients navigate
Yeah.
that landscape. But on the miner front, we have a question here about Bitcoin native DeFi. We've seen miners benefit quite a bit recently from an uptick in fees from ordinals. It seems like there is a lot of energy around developing a layer 2 solutions for Bitcoin. Are you guys doing anything in that arena? Are you interested in it? If not,
I mean, yes and no. I think it's early. I don't think a lot of we've looked at a lot of stuff. Like we've looked at, obviously Lightning and what Jack's doing with Block and a lot of other stuff. I mean, Bitcoin is really old technology. I don't think Bitcoin needs a layer 2 to be successful. I mean, yes, there is an enormous amount of mining hash rate that you can basically take advantage of free security. But that's probably going to go down pretty rapid. There's going to be a lot less hash rate probably in 20 years, or maybe just because the rewards are going to get so much less. So I think it's interesting that the ordinals and people putting NFTs on Bitcoin. I mean, it killed the network. I mean, the Bitcoin network, I mean, it was the best idea anybody had at its time, and it's been really surpassed, by every other technology, after that. So I think, I mean, Ethereum, Solana, Cardano, like all the different platforms out there that I think are going to be the world machine, the processing engine, the decentralized finance platforms. Bitcoin is beautiful. I will never sell a lot of my Bitcoins I own, probably. And I think it's going to continue to be the forefront leading the market right now. I think Bitcoin will be $1 million a token someday. So I'm very, very pro Bitcoin price movement. I'm pretty negative on it being a processing layer, long term. I still think it's very well. It's just not really built for it. I mean, I come from an old era of crypto. Like in 2013, I invested in a bunch of we used to call them color coins. They were coins like Omni and Mastercoin and whatever that were built in the Bitcoin network, and they didn't work. I mean, it was a disaster. I mean, the processing, 20-minute finality on a transaction, it was impossible then, and it's still really, really hard. And Lightning solves some of those kind of things and some of those other kind of scaling solutions, but there's better platforms.
yeah. Yeah, I think the perk is that you would have these platforms attached to this, what I view as the most decentralized, digital commodity money, right? That is the least disruptable of any network out there. And the whole idea is that you could build payment layers on top. I agree with you that it is a challenge, and I'm not sure that, we'll see if the market responds to the challenge and builds out some solutions. It will be a difficult task, but yeah, I'm excited to see what happens. Let's see, so we're running up on time. We'll do one more audience question and then wrap it up. We have a question here. Do you think Celestia and modular-based chains will enable new DeFi primitives, or will we see more of the same?
Yeah, so I'm a fan of those. I mean, we invested in like EigenLayer and Layer Zero and some other types of, not Celestia specifically, but a lot of the kind of like more foundational type chains that we think will offer a lot of interoperability. And I think they will allow, but I mean, they're going to solve problems in a crypto world. I'll say it. Let me say it first. I don't want to get too technical on this call. So I'm guessing most of the audience might not understand my answer if I go technical. So there's a lot of challenges that all these things can solve that are really more cross-chain issues and very deep technology issues around maintaining security, synthetic assets, bridging of assets. You know, if you have a great real world asset on one chain, you know, Ethereum, and you're trying to take it to another chain, that's really, really hard right now. And those platforms will help, you know, solve a lot of those problems. I think to the people in this audience, I think Celeste is an interesting investment. I think Eigenlayer and Layer Zero are fantastic investments, or will be whenever the tokens come out, and Stark and all the different ones. But yeah, so there's a lot of stuff. I mean, I'm blurring a lot of things together. So yeah, so I think it's really important. I think it'll solve a lot of problems eventually. But they're pretty deep technology problems that most of the world will never deal with. So I think they're good investments.
Yeah.
But they're
I think
very
broadly crypto has this
crypto
problem
specific.
of like abstracting away like the technology aspects from the user. You know what I mean? It's I think there's still too much interfacing with the deep tech to have
Oh yeah, the
you know,
biggest
the
problem
next
in
100
crypto
billion.
is blockchains are really, really hard to simplify. So people have been trying, but it's, you know, they're bearer instruments, they're easy to get lost. Everybody I know has lost lots of crypto assets in this space, you know. I mean, personally, I'm like companies even. And everyone's like, oh, we just need a better wallet, we need better user experience layers. And that's true, but it actually is really, really hard. As soon as you make a beautiful user experience, then if anything goes wrong, it's not technical usually. And things seem to go wrong a lot. So, you know, for most people, like I used to hold all my own crypto assets, and I have a company now that I don't have to hold my own crypto assets, which is really, really amazing because I hated it. But that's still an indictment of the space. I was a programmer, you know, for years. And I really struggled to like properly feel like I have proper safety, safeguards, backups, you know, whatever security around my, you know, crypto assets as an individual. And I mean, the reality is, I mean, most, you know, I love the phrasing. Some people use, you know, not your keys, not your coins, you know, this is independence and whatnot, you know, but like not having systems around these things at this level is really, really hard. Like we use 11 different custodians, we do self-custody for some of our assets. Like everything we touch goes through like human, you know, video calls and everything else. And, you know, and I don't know how, yeah, I understand how people that do it individually have a lot of challenges.
Yeah.
Because if it's just you and something gets hacked or something gets broken or whatever, you just can't have the redundancy as a one person. You know, we can have it as a, you know, 40-person firm, but
Yeah, no, and it's certainly a challenge for the industry. I know people that are working towards solving those issues, and I think it's kind of a chicken and the egg problem, right? You need users to create demand for better UX solutions, but you need UX solutions to get new consumers to, you know, do stuff on chain. And so I think we're slowly moving in that direction. But
yeah.
look, we're
Well, the
running
real
tight on time
fundamental
here,
problem
so I
is
just yeah, go
oh,
ahead.
sorry. So the really fundamental problem is humans are bad at security. Like convenience rules the world. Everyone complains about like Facebook and everything else, but if it's convenient, people will do it. And everything that's security wise is incredibly inconvenient. For us, moving assets is a huge pain in the ass internally at our company. You know, it takes multiple people, it takes hours. There's all these video calls and YubiKeys and shards and everything we have to keep all of our safety in place. And it's horribly inconvenient. It adds huge operational layers to us. So most people just won't do it. You know, they'll have a Trezor, but they won't, you know, divide keys and use safety deposit boxes and safes and things like that because it takes, and you can't do stuff easily. If something's going wrong, the market's crashing, and it takes hours to get your assets, that's kind of bad. But you know, that's the world we live in. So I think it's going to take a long time, much longer than most people think, before those problems are solved.
Yeah.
Because humans are just bad at security. You know.
It's true. You're absolutely right. I I'm sure there are more than one person out watching this that uses password 123 as one of their passwords on a number of services. But yeah, so I think, you know, we're running tight on time here. I just want to kind of give you the ball to bring us home here. So I think you alluded to it earlier. This is not, you know, we're not a BD, is not a solicitation, but I understand you guys are raising capital. And of course, if anybody from our network, people watching this are interested, you can definitely reach out to learn more. So maybe, you know, Dave, you want to take us home, tell us a bit about that, what the proceeds are going to be used for, and kind of just what you're excited about seeing over the next 12 months.
Yeah, and again, this has been the most fun time. I mean, I've had a lot of fun running this company. I've sold a couple of companies already, but this has been the most fun and the most fun period ever. The world is wide open. There's been a lot of just this chaos around us, but it didn't impact us. And we're one of this, I like to refer to us as the Bubba Gump shrimp boat of crypto. Is that all the storm took everyone else out, but there we are, and we're profitable. We make great money. We always have, or just always have since the last several years. And yeah, and there's a huge amount of just expansion opportunities right now. We figured out the regulation piece, which a lot of our peers didn't. We figured out risk mitigation. We've got great financial products. Our clients are not the ones that leave crypto. Our 80 some percent of our AUM comes from, I mentioned, like some of the largest protocols in the world. Like they're here. The market, Bitcoin goes back to 15K or whatever, they're here, they're not going anywhere. And there's still lots of good things we need to do for them. So we have a lot of resilience in that respect. So again, raising a $30 million just convertible note. Majority of that is committed fully. A lot of it's already wired, and yeah. So if anyone is interested, we'd love to have more participation. And yeah, and I think the future is really, really bright. This is a great time in crypto. Obviously, the market price recovery is kind of nice. At some levels, I actually wish the price hadn't recovered, because we actually doing really well without the price recovery. And I'm kind of like watching our peers struggle because they have different product sets and so forth. But I think the run is here anyway. So I think there's just a lot of enthusiasm right now. And for us, being an asset manager is one amazing thing about a crypto asset manager, and this cuts both ways, is we manage many hundreds of millions in crypto, and we manage long tail assets mostly. Very, very little we hold as Bitcoin or Ethereum. So Bitcoin is only down like 35% now, but like, Cardano is still down, whatever, 80%. Solana is still down 80%. And those will recover. Bitcoin goes back to 60,000. Those will probably go back to where they were also. Assuming it holds it for a while. And that's not a, 40% up, that's a couple 100% up. Without us having to do a whole lot. So there's a lot of really interesting leverage in our business as the market kind of gets better.
Yeah, could not have put it better myself. Only thing I will disagree with you and agree to disagree with is that things are not better when prices are higher. I, for one, like it. Cool. Well, Dave, thanks for joining us. Thank you all for tuning in. Again, if you have any questions or are interested in learning more about Wave Digital Assets, definitely feel free to reach out. Until next time, thank you all for joining. Happy holidays. Take care.